Welcome to the deep dive. Sometimes the biggest problems, they seem to have the most surprising, almost kind of mind-bending solutions. Imagine, just for a second, you're the U.S. Treasury Secretary, your main job. Find huge amounts of cash to fund government spending that just keeps growing. And you have to do it without hiking taxes or, crashing the whole economy. It's a heck of a balancing act.
It really is. And for this deep dive, we're actually pulling insights from this really provocative analysis by Arthur Hayes. It's called Quid Pro Stablecoin, the Treasury's Liquidity Gambit. So our mission today is to unpack the complex, sometimes hidden, realpolitik reasons, the practical, maybe even cynical side of politics behind these surprising financial moves, and figure out what they mean for the economy and, specifically for you.
Okay, let's dive into that. This colossal task. Just picture being a Treasury Secretary like Yellen recently, or Scott Bessent now. The core challenge seems simple on the surface. Fund government spending. Because look, politicians, it doesn't matter which party they spend money, but they consistently, don't want to raise taxes to cover it all. So the Treasury's left, holding the bag, trying to bridge that gap.
Yeah, and what's really interesting now is how the market seems kind of reluctant to buy long-term government bonds, especially, at high prices and low yields. The author Hayes, he calls it a doom porn twerk-off, his words, not mine. This dramatic surge in 30-year bond yields we're seeing everywhere.
Everywhere. Like where?
Well, the UK, Japan, us here in the US, Germany, France, it's a global thing. And it's not just rising yields. Think about the real value of those long-term US treasuries. There's this ETF, TLT, it tracks the long-term stuff, over 20 years. Well, if you measure that against the price of gold, its value has plummeted, like 71% down over the last 5 years.
71%? Wow.
Yeah.
That's a huge drop in real terms.
Huge. It shows how much faith has eroded in the long-term value of holding that debt.
And the scale of the funding needed is just mind-boggling. We're looking at something like $2 trillion in yearly deficits, plus another, $3.1 trillion of debt that's maturing just in 2025. That all needs refinancing.
Exactly. And think about the big expenses. Defense, with wars ongoing, and healthcare, especially as baby boomers age. These costs are growing faster than the economy, faster than nominal GDP.
Which means the interest payments on the existing debt just keep climbing as it gets rolled over at these higher rates. It's like a snowball effect.
It absolutely is. And that brings us to these critical constraints the Treasury is operating under. They have to sell bonds, but they can't let the main benchmark, the 10-year yield, go over 5%.
Why 5% specifically? What happens then?
Well, when it gets near 5%, bond market volatility just explodes. There's this thing called the movie index, kind of like the VIX for bonds, it spikes. And that's basically a flashing red light for a potential financial crisis just around the corner.
Okay, so avoid 5% yield. What else?
Crucially, they also need to sell these bonds in a way that actually helps the broader financial markets, like the stock market. Because, as Hayes points out, the government relies heavily on capital gains tax revenue. A rising stock market means more tax money, which helps keep those fiscal deficits from becoming mind-bogglingly large, as he puts it.
So, keep yields down, keep markets up. Tricky.
Very tricky. And Hayes offers a pretty sharp perspective here. He suggests the U.S. government, fundamentally, exists to serve wealthy property owners. He points to the 2008 crisis the Fed saved the banks, right? But millions lost their homes to foreclosure, he calls it. Socialism for the rich, capitalism for the poor. Pretty stark language.
That's a very pointed critique. Is he saying that's the intent or just the outcome?
I think he's focused on the outcome, the realpolitik. The actions taken, even if framed as saving the system, ended up protecting asset holders disproportionately, while others bore the brunt. It's about who benefits in practice.
Got it. So, okay, back in the day, the Federal Reserve used to kind of handle this, right? They did the heavy lifting.
Yeah, exactly. Through QE, quantitative easing, they'd essentially print money and buy up government bonds. Made the Treasury's job much easier.
But now,
the Fed needs to look like it's fighting inflation. So large-scale QE is off the table, politically at least, which leaves the Treasury Department largely on its own to conjure up these trillions in liquidity, and this is where it gets really creative.
Right. This brings us to Janet Yellen's time. She had a strategy for this, didn't she?
She did. Hayes calls it activist treasury issuance, or ATI. And she used it pretty effectively back in Q3 2022 when the market was getting shaky and selling bonds.
ATI. Okay, how did that actually work? What did she do?
It sounds almost simple. She just shifted the type of debt the Treasury was issuing. More short-term stuff, Treasury bills, T-bills. the ones that mature in under a year and don't pay a coupon.
So fewer long-term bonds, more short-term bills.
Exactly. Compared to the longer-term notes and bonds that pay coupons, a subtle shift in the mix, but with massive consequences.
And what was the impact of that shift?
Huge. It essentially sucked liquidity out of the Fed's reverse repo program, the RRP, to the tune of $2.5 trillion over about 2 years.
$2.5 trillion pulled from the RP.
Yeah, that money flowed back into the system, and it effectively pumped financial assets. Think the NASDAQ 100, think Bitcoin. They rallied. And crucially, it did the job of keeping that 10-year Treasury yield below the danger zone, below 5%.
So it worked. It shows the Treasury can pull levers, even without the Fed doing traditional QE.
Precisely. It set a precedent. The Treasury can be strategic, an active player in managing liquidity and market.
Okay, so if Yellen had ATI,
Yeah.
what's the play for the current secretary, Scott Bessent? The author calls his potential tool a new favorite monetary bazooka involving stablecoins.
Yep. Stablecoin.
Which feels odd, right? Because I definitely remember the huge political fight when Facebook tried to launch Libra back in 2019. Massive pushback. But now, suddenly, we're seeing bipartisan support for something called the Genius Act related to stablecoins. So what gives? What changed?
Well, according to Hayes, if you look through that realpolitik lens again, the reason is pretty simple, almost transactional. He argues that allowing regulated stablecoins, specifically from banks, will unlock a massive amount of T-bill purchasing power.
How massive?
Potentially up to $6.8 trillion, primarily from the big banks, the too big to fail banks, or TBTF as he calls them.
$6.8 trillion. Okay, walk us through how that works. The stablecoin flow, which banks are we talking about?
So he identifies the big eight: JP Morgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, State Street, and Bank of New York Mellon, the usual suspects.
Sure.
These guys are launching their own stablecoins. Like JP Morgan has JPMD, and it actually runs on a public blockchain base, which is built on Ethereum.
Okay, and how do they get customers to use these?
They entice you, the customer, to swap your regular bank deposits. The slow ones that only work banking hours for these new shiny stablecoins. These operate 24/7, 365, instantly. And they might even throw in perks like cashback rewards.
Okay, so convenience, maybe some perks. Why are the banks so keen on this, though? What's in it for them besides happier customers?
Well, Hayes points to two huge reasons for the banks. First, massive cost savings. Because these stablecoins run on public blockchains, everything's transparent. He argues AI agents could handle compliance flawlessly, generate regulatory reports instantly. This could slash the roughly $20 billion a year those big banks spend on compliance, potentially down to effectively zero, in his words.
20 billion saved. Okay, that's big. What's the second reason?
Risk-free profits from T-bills. This relies on a key assumption: that treasuries get a full or partial exemption from something called the supplemental leverage ratio, the SLR.
The SLR, that's a capital requirement, right? How much cushion banks need.
Exactly. If treasuries are exempt, banks need to hold less capital against them. And the Fed has already voted to reduce some capital requirements, which Hayes estimates frees up about $5.5 trillion in bank balance sheet capacity just to buy treasuries.
Okay, so they have more capacity to buy treasuries.
Right. And they can buy T-bills, which Hayes describes as high-yielding, zero-duration, cash-like instruments, using the money customers put into stablecoins. And here's the kicker. By law, these bank-issued stablecoins cannot pay interest to the holders.
Oh, so the banks collect the interest from the T-bills they buy.
Exactly. But they pay out zero interest on the stablecoins backing those purchases. That creates a really nice net interest margin, or NM for them, basically risk-free profit, backed by the government's need for someone to buy its debt.
Wow. So reduced costs, risk-free profits. Hayes must have a prediction for what this does to bank stocks then.
Oh yeah, he gets pretty specific. He calculates this could boost the stock prices of these TBTF banks by an average of 184%.
184%.
Based on their average PE ratio, yeah. Taking their total market cap from around $2.1 trillion up to potentially $3.91 trillion, he even suggests it as a trade. Go long an equally weighted basket of the TBTF banks, calls it a non-consensus trade.
That's a bold call. Does he mention any risks? Or what about competition? Can other companies get in on this?
Well, he argues the system is kind of rigged against competition here. He points out that this Genius Act seems designed to prevent non-bank issuers, like Meta is trying to be, from competing at scale. They'd likely have to partner with a bank.
Okay.
And that rule about stablecoins not paying interest, that stops fintechs, like Circle perhaps, from easily attracting deposits away from banks by offering a yield. They can't afford to siphon deposits that way. Plus, let's face it, the TBTF banks have that implicit government guarantee on their liabilities. Smaller banks, fintechs, they don't have that same level of perceived safety, so the public might naturally trust a JPM coin more.
So, summing up the stablecoin part from Hayes' perspective, it's a strategic deal, a quid pro quo.
Pretty much. He basically says the government, the BBC, as he calls the big bank cartel, is giving the banks this gift. It helps them squash fintech competition / compliance costs with AI, boosts their profits because they don't pay interest on the stablecoins, all leading to higher stock prices for them.
And in return,
the banks use that stablecoin cash to buy up potentially $6.8 trillion in T-bills, solving the Treasury's funding problem. A neat, if cynical, circle.
Okay, that's quite the theory. Is that the only trick up Bessent's sleeve, according to Hayes?
No, there's a second major lever he thinks Bessent will push for, potentially ending the interest on reserve balances, or IORB.
IORB. That's the interest the Fed pays banks just for parking their reserves at the Fed.
Right, exactly. It started after the 2008 crisis, kind of to make sure banks had enough safe reserves and didn't fail.
But what's the impact now, with rates higher?
Well, now the Fed is paying out quite a bit of interest on these reserves, which are just sitting there, mostly dormant on the Fed's balance sheet. As the Fed raised rates, this interest expense ballooned. It's actually put the Fed in a negative cash flow situation. On paper, the Fed looks kind of insolvent because of these payments.
That sounds awkward for the Fed.
It is, and politically sensitive. You have figures like Senator Ted Cruz arguing that ending IORB would help lower the federal deficit. Hayes' take is that ending IORB would effectively force banks to do something else with those reserves, currently around $3.3 trillion.
Force them how? Where would the money go?
Well, they'd lose that risk-free interest income from the Fed, so to replace it, they'd likely pour that money into the next safest thing that offers a yield. Treasury bills. T-bills again.
So ending IORB pushes another $3.3 trillion into T-bills.
That's the argument. It would act like another huge dose of QE for the Treasury market, but without the Fed having to actually announce QE or print new money explicitly. It's QE by another name driven by regulatory change.
Okay, let's put this all together for you listening.
Yeah.
We've got the stablecoin plan potentially funneling $6.8 trillion into T-bills. And ending IORB potentially pushing another $3.3 trillion into T-bills.
Right.
So the author is predicting a combined potential influx of, $10.1 trillion into the short-term Treasury market over time.
That's the number Hayes puts forward, $10.1 trillion. It's a staggering amount of liquidity aimed squarely at T-bills.
Can the expected effect of that much money flooding in?
Hayes is pretty blunt. PMPUP, the jam. His words again. He expects it to significantly boost risky assets, just like Yellen's smaller $2.5 trillion ATI injection did before. More liquidity sloshing around tends to lift asset prices, like stocks and crypto.
Okay, massive liquidity boost expected eventually. But is there any caution in the short term?
Yes, there is. He throws in a cautionary tale for the immediate future. He thinks there could be a temporary dip in dollar liquidity right after, say, a big spending bill passes and the debt ceiling gets raised again.
Why dip them?
Because the Treasury needs to refill its checking account, the Treasury General Account, or TGA. It's currently low, around $364 billion. He estimates they'll need to bring it up to maybe $850 billion.
How do they refill it?
By issuing more debt, which means sucking cash out of the system. He figures about $486 billion needs to be pulled out to refill the TGA. And remember the reverse repo program, the RRP, that Yellen drained? Its balance is pretty low now, only $461 billion. It's not big enough to fully offset that TGA drain anymore.
So a short-term liquidity squeeze is possible.
That's his prediction, a temporary contraction. Because of this, his short-term forecast, say for Bitcoin, is maybe sideways to slightly lower trading. He throws out a range like $90,000 to $95,000, perhaps until late August or early September.
But after that? After the TGA is full and the spending taps are open again.
Then he expects a significant bullish shift. Debt ceiling raised, TGA refilled, politicians spending like always. That means more money creation, more liquidity flowing, pushing assets higher again.
So putting it all together, what's the big takeaway investment philosophy from Hayes' analysis here? It sounds pretty unconventional.
It is. He's basically saying, forget waiting for the Fed chair to announce QE or rate cuts in the traditional way. That's not where the action is right now. And don't get too excited about the potential of traditional fintech stablecoins like Circle. He thinks they're being sidelined.
So what should you focus on?
He argues you need to understand that the government has essentially handed the too-big-to-fail banks the keys to this multi-trillion-dollar liquidity bazooka, but disguised it as financial innovation. He's very clear. This isn't DeFi. It's not financial freedom. In his memorable phrase, it's debt monetization dressed in Ethereum drag.
Wow. Okay, so his practical advice is
Go long Bitcoin because it benefits from this macro liquidity tide, and go long JP Morgan as a proxy for the TBTF banks benefiting directly. And basically forget about players like Circle.
right. As we've gone through all this, the real aha moment for me is how things that look like tech innovation or even steps towards financial freedom, when you look at them through this author's admittedly cynical lens, they start to look like something else entirely, like clever, pragmatic tools for managing government debt and keeping the existing financial system stable.
Exactly. It's less about the shiny new tech itself and more about how that tech can be used to solve very old, very large government problems.
Yeah.
This whole deep dive really shows how things that seem totally separate, stablecoin adoption, obscure central bank rules like IORB, can actually be deeply intertwined with the government's fundamental need to fund itself. And it leaves you with a really important question to chew on. What other financial innovations, things that seem benign or purely tech-driven on the surface, might actually have a hidden, deeper purpose in the grand game of economic policy? And what does that realization mean for how you understand the way the world really works?
Really powerful questions to think about. We hope this deep dive gave you some food for thought on that complex dance between finance, technology, and government power. Until next time, keep digging deeper.